Okay, so let's talk about trading. What do you think your biggest problem is? If you're not having the kind of success that you want to have, what do you think the biggest thing is that's in the way? What do you think you would like to improve? Okay. Now we've had just a few folks. Okay, now we're having them pour in. The votes are pouring in. That's good. Okay. I like to hold out for 100% participation, but I know that some of you call in rather than being at a computer screen, and so obviously I can't get your vote. But as much input as possible is best. This helps me to craft better presentations for the future, and also it's going to help you open up your mind, open up your understanding as far as what needs to be done. Okay? All right, so let me go ahead and close this poll in 3 seconds, 2 seconds, 1 second, close. Now this is surprising. Nobody picked the last two, okay? But the first two answers are where most people look. Where most people look is these first two answers. 17%, I need to do a better job at picking stocks. Okay, so what you're essentially saying to me is that you think that you'll do better if you pick good companies to trade. I'm going to go ahead and say that may not be the best approach, and here's why. Apple Computer, in 2008, Apple Computer went from $200 a share to $88 a share in about an 8-month period. So it lost 56% of its value. You'd think that it's because the company was doing very poorly, but it wasn't. You see, the company, Apple, was making money for itself hand over fist. Instead of $3.5 billion profit in 2007, it made about $6 billion profit in 2008. So what's the explanation? Well, the market does not always pay attention to how well a company is doing. It just doesn't always do that. Okay, 33% of you said I need better timing for my entries and exits. In today's class, probably the title of the email that I sent you probably piqued your interest a little bit. I talked about calling the market top. And the thing is, I can't tell you that I've got a crystal ball. I don't. I don't have a crystal ball. And if I may, neither do you. Neither do you. If you had a 100% reliable way to pick winners in the market, you probably wouldn't need to tune in today. Okay, so I'm going to say that better timing for entries and exits is, it's helpful. Choosing a good company is helpful. But what most folks said, and what I can help you with today, most folks, 50% of you, half of you said, I wouldn't mind losing a few trades if my losses were small. And that's where we're going to begin. I found out that once I started keeping my hands up, the rest of my fight game took care of itself, okay, as a martial artist. As soon as I learned to keep my hands up, the rest of the fight game took care of itself. And it's the same in trading the market. Once you learn how to not get hurt when you do take a loss, just make it minutely small, all right, then the wins seem to take care of themselves. And that's where we're going to begin today, okay? All right, let's see. I'm going to just check in here quick and see if there's any questions. Checking in. Tom says, good day. Good day, Tom. All right. Very good. Right now, there doesn't seem to be any questions, so I'm just going to plod on ahead, okay? I think you're going to really dig this. Bulletproofing with the income methods. Oh, I would like for you to introduce yourself if you get a chance anytime during this podcast, okay? Just let me know where you're coming from. Tom already wrote in. He's in Spain. Okay, and I might also like to know what kind of options plays you're doing now. If you're doing covered calls or if you're doing long calls, long puts, if you're doing spread trades, things like that. Today I'm going to be sharing some things that will go against the grain a little bit for just about everybody. I've got something in this podcast to offend just about everyone, but I think you're going to actually enjoy it because I'm going to share with you some ideas that go against conventional reasoning, but that work very, very effectively. Okay, and that's what matters. The old adage in the Army is if it doesn't make sense but it works, it makes sense. Okay, if it doesn't make sense but it works, it makes sense. Okay, so in this webinar, I'm going to make you 3 bold promises. Number 1, I'm going to show you the solution to a big problem that faces buy and holders today. And in fact, I'm willing to bet that you're going to take a look back at your trading account for last year and wish that you had been employing this already. later on in the webcast, the podcast. I don't know what I'm doing here. Webcast, podcast, broadcast. I'm casting. All right. So I'm going to bet that you're going to wish that you had done this. And I'm going to also bet that some of you that have a stock that's up from where you bought in are going to want to employ it. And I'm going to actually take your stock live and do a demonstration with it. Okay. So if anybody wants to supply their stock and their cost basis, I'd be happy to share that information with you. Okay, here's the second promise. I'm going to show you a riskless spread trade. Now, that didn't sound right, but this is a spread trade that's done at a credit that can never hurt you. Normally, a credit spread involves risk, but remember, I said it'd be riskless, and there's a catch. There is a catch. It has to be done in a certain context. Okay, but when it is done in that context, the trade itself is riskless. It's possible to really take income from your stock without necessarily selling it, and it's possible to take income without limiting your upside. Now, for those of you that trade cover calls, that's going to be big news, right? Be able to take a credit, but not cut the upside. Okay, so that's kind of exciting. Okay, here's the third promise. Number 3, I'm going to show you how to ratchet up your exit point, not with a trailing stop loss order, but with something real that guarantees a better exit. During the flash crash of 2010, May 6, 2010, my mother gives me a call. She says, "Oh, honey, I just heard that the Dow Jones or something, that it fell 1,000 points in 15 minutes. And I know you do things with the stock market. Are you okay?" And I said, "Yeah, Mom. I was actually taking a nap, and if you don't mind, I'm going to go back to sleep. I'll call you later." And the truth of it was that I was long stock in about $100,000 invested. I was long stock in across 8 or 9 positions, and I knew that I couldn't lose. In some of them, I knew that I couldn't lose, and in others, I knew that if I did lose anything, regardless of what was happening in the market, I was going to have maybe a 1 or 2%, 2.5% loss in those stock positions. Okay, so what I'm going to share with you, and some of those positions could not lose. And that's what I'm talking about here. Not a trailing stop loss order, but something real that guarantees a better exit. Okay? All right. So, you know what? Normally I do this. Normally I take a baseline reading. I find out what kind of options trading you're currently doing and how happy you are with your trading results. Maybe I could just cut that down to one question here. Let's take a look here and see my prepared polls. Yeah. I'm going to say, how's it working out for you? How's your trading working out for you? Some of you texted in, told me what you were doing. Some folks are doing long calls and puts. Some folks are doing cover calls. Okay, now how's that working out for you? You know, how are you doing? I mean, really. And don't worry, I'm not going to embarrass anybody. I'm not going to call out your name and say, "Oh, John Smith, you know, so you've been doing this and losing money." Haha. You know, nothing like that. Okay, this is just for your use. I just see a number. I just see a percent. Okay, I get to see, just across the board what people are doing by running polls like this twice a week for the last 7 years now. I've seen a lot of trends. Okay, all right. Right now it's it's evening up pretty much the way I normally expect to. In fact, the amount of folks that are winning is higher than normal. So we've got some savvy traders here, but we still have losing trades outnumbering the winning ones. Okay, let me go ahead and close that poll. It's been 1 minute, and this is how it fell out. We've got 20 people in the room. We've got 40%. That's 20 people in the vote. Okay, so 20 people have voted. So what is this? 40%. That's 8. Said I picked more winners than losers and managed to win last year. Great. Okay, and then the other 12 said I picked more losers than winners and ended up losing last year. Okay, now the next 3, I actually get very often in these webcasts, I get all 5 categories picked. You know, there's a representative from somewhere in each of these categories. But very often I do see people, in fact on Tuesday I saw a lot of people that said I picked more winners than losers but still managed to lose last year. I picked more winners than losers but still managed to lose. And we had a minority. We had a very small amount that actually did this. I picked more losers than winners, picked more losing trades than winning trades, but still managed to win. And by the way, we also had some owners of the blueprints on the line at that time. I suspect that may have been them. Okay, because that is something that we teach. We teach you to be able to make money, even if you're lousy at picking stocks or timing trades. Okay, let me go ahead and oh, I didn't share it. Let me share it. Okay, so there's the results. Okay, and then I'll go ahead and hide them. I'm going to check again for questions. Okay, no questions. We don't have any questions yet, and that's cool. I just need to jump in there every once in a while. So here's the problem and what we're going to do to fix it. Okay, the problem is you don't know the future. Okay, I don't know the future. You don't know the future. Welcome to the club. Okay, so here is what happened. We had a client come. This is about this around this time of year, about 3 years ago. A fellow named Ravi, and he was long 1,000 shares of RCI. Okay, long that just means that he owned 1,000 shares of RCI. And he said, geez, guys, I would like to have a way to protect my stock, but I'd like to see if it keeps going up. If it keeps going up, I'd like to, take advantage of that win. On the other hand, if it goes down, I don't want to take, a loss. And I also don't want to pay anything for insurance. And I said, wow, you don't ask much, do you? But here's the thing. Right there on March 26, 2012, we had no idea what was really going to happen next. We could hope by looking at this chart pattern that RCI was going to continue up and that it would be a good idea for Ravi to hold his stock. Okay, we could hope that. But what might happen after this hard right edge, what might happen is that the stock might just falter and crumble. All right, and so we didn't know what was going to happen, which puts us in good company, okay, because nobody knew. All right, so now what? Here's the deal. Ravi's in a place where his stock was up from where he had bought in. The stock was trading on that day at $38.95, and he had a cost basis of, oh gosh, I think it was like $27 a share or something. He had a cost basis that, had him as a winner. Okay, I think it was $27.50. We'll see in the slides. Okay, all right. So here's what everybody is faced with when they've got a stock that's up from where they got in. And by the way, if you don't have this problem, you want this problem. Okay, you want to have a stock that's up from where you got in, right? Okay, so the problem was this. Ravi said, and I have said, and you've probably said, I don't want to feel like a chump. Okay, if I sell my stock and it keeps going higher, I'm going to miss the boat. Okay, no fun. And that's so poignant that I made it into a haiku. Okay, but the other thing is, on the other hand, if I hold it, I might give back my profits. Stock goes down the drain. There's another haiku. Honestly, I have actually, before discovering the method of trading that I'm going to show you now, before that, there was a stock that I got into in the late 90s. One of the very first, companies, one of the first companies to utilize the MP3 technology for having MP3 players. Okay, no moving parts. They told me, wow, you know what? There's no moving parts, and you can store up to 50 songs. I was like, wow, up to 50 songs, really? Because I remember the days of the Sony Walkman, and you had to carry your cassettes with you, and it was real bulky. And what's on a cassette? Like 8 songs or 15, something like that. Well, anyway, I invested in that company heavily. And guess what? It was not Apple. All right, it was one of the predecessors, and they failed. I got in at $9.50 a share. When it went to 12, I felt like a genius. When it went to 18, I felt like a god. When it went to 24, I thought, man, this is never going to stop. This is awesome. But then when it came down to $16 a share, I couldn't sell. Couldn't sell because it had been at 24. And then when it went down to 12, I said, well, no, I definitely can't sell now. It's at half value. And, I got in at $9.50. I'm still comfortable. But then it went down to $8.50, and I was like, not comfortable anymore. And then it went down to 26 cents, and then it disappeared. It went to the pink sheets. I got out at 26 cents a share. Guys, this has happened to more people than care to admit it. Okay, I'm going to admit it because I want to tell you, hey, look, this is how I got here. This was the journey. All right. if you're holding on to a winning stock, you might talk yourself out of a winner. You might be sitting on a winning stock that'll turn into a loser. And so the solution to that is what I was searching for. Okay? So this far right edge is everyone's enemy. It's everyone's enemy. Okay? And here's what actually happened. If we had the benefit of a crystal ball, if we didn't know what was going to happen, certainly, we would have seen that on this date, April 17th, that stock was going to peak, and then after that, it was going to just freaking crumble. And that's exactly what happened, okay? Now, Ravi's thought was he wanted to be in for it for as high as it was going to go, and he didn't want to have to participate in any of this stuff. And I think that's wonderful, okay? I mean, that's exactly where we'd all like to be. So would you like to see what I showed him? Here's the deal. The reason that this problem hasn't been solved yet, the problem of should I stay or should I go, okay? It's not just a song by The Clash. It's a problem that pervades all of our trading once we're into it, okay? Even when you buy consumer items, you get buyer's remorse. You know, should I return this? Or I don't know. All right, so why hasn't the problem been solved yet? The problem is we've been only talking about two choices. Hold the stock and, you know, cross our fingers and toes and hope for the best, right? Or sell the stock and hope that that was the top and you don't get, don't feel like a fool. Okay? Well, the thing is, when you ask better questions, you get better answers. I'm here to tell you that there is another option if you want to cut your losers short and let your winners run. We should have been asking a better question. The better question to ask is there a way for me to lock in my winnings or most of my winnings here and still hold in case it goes up? Okay, and so here's what I'm going to talk to you about. This is called structuring a bulletproof RPM or radioactive profit machine. This is the structure of it. Okay, on March 26, 2012, RCI shares were trading at $38.95, and our good friend Ravi had shares at a $27.50 cost basis. Okay, so he's got a gain to protect there of, what is that, $11.45. He's got a gain to protect there. He wanted to know if he could bulletproof his stock without spending anything. You see, what we talk about all the time is buying a long-term, slightly in-the-money put option. Okay, we talk about buying a long-term, slightly in-the-money put option, far away. Okay, well, here's the deal. Ravi was able to bulletproof immediately because of the fact that his stock was up from where he got in, okay? But what I'd like to do is I'd like to demonstrate how it would be for you and me if we got in on that same day, okay? If we got in on that day, we would not have a $27.50 cost basis. We'd have to pick up the stock at its current price, or then current price of $38.95. But the setup is the same. The setup for what I'm going to show you to protect yourself and not spend anything, okay? And also the setup for Ravi to protect himself and not spend anything. It's going to be the same, okay? He's going to be able to pick up an insurance policy and not spend anything out of pocket for the insurance policy. That sounds really good. So let's find out how this is done. By the way, many of us don't have the advantage of owning a stock that's way up. So I'm going to show the same perspective or the same setup from that perspective. The perspective of a retail investor getting in without a break in price, okay? But listen, if any of you on the line today are sitting on a stock that happens to be up from where you bought in, let's say you've got Apple and you've got Apple at a cost basis of $100 a share, whatever it is, let me know. And using the Power Options platform, I'm going to go ahead and show you how you might be able, if it's available, if it's possible, how you might be able to do exactly what I showed to Ravi, okay? All right, so here we are. It's March 26, 2012. RCI shares are trading at $38.95. Now, Ravi has already got these shares. He's got 1,000 of them at a cost basis of $27.50, so he's sitting pretty. But if you and I were to get in, we'd have to pay, pay the price. We'd have to pay full retail. We'd have to pay the $38.95. Now, here's what we're going to do. We're going to buy an in-the-money, far away in time put option. And actually, this isn't as far away in time as I usually like to go. All right, this is, what is this, March, April, May, June, July. So it's about a 4-month hold there, okay? Now, what's happening is we're buying an in-the-money put option because of the way that they behave, okay, because of the way they behave. And I'll be explaining why that is later. But here's our total cost basis, you and me, okay, if we were bullish on RCI and we got in, we would pay $41.85 for this structure. Now, here's the benefit of the structure. If the stock crumbles, we have purchased for ourselves the right to sell the stock at 40, no matter what happens, okay? So really, all that's at risk is we've solved for the time value of the put, okay? Some of this put is intrinsic value, okay, and some of it is time value. $1.05 of it is intrinsic value, and $1.85 of it is time value. And the time value is all that's at risk. And if you take that time value and you divide it by the total amount that we've put in, we're only risking 4.4% of what we put into this play. Now, that's important, okay? There's a lot of folks who say, well, you could accomplish something really similar with a long call option. Yeah, similar, but not the same. Plus, there are adjustments that you cannot do if all you have is a long call. I'm going to be showing, there's 12 different income methods. I'm going to be showing 2 today. And I think you'll really dig it. Okay, I'm going to show you two income methods today and probably neither one you could do with just a long call, unless you have a very high trading clearance. Okay. All right. So let's and one of them you just can't do because it depends on having a put. Now wait a second. I know that you might be saying, hey, you said you weren't going to pay anything for the insurance policy. Didn't you say that you weren't going to spend anything? And there I showed where I'm spending $2.90. Okay. Well, fair enough. Okay. So here's what we're going to do. We're going to finance the cost of that put option. It costs $2.90 for that put option. And what we're going to do is we're going to do one of the income methods from the blueprint, one of the radioactive trading income methods. This is a bear call spread where we're selling the April $35 call. This is in March that we're doing this. We're selling the April $35 call and simultaneously buying the April $40 call, generating a credit of $3.30. Okay. Now that credit of $3.30 is going to pay for our insurance policy. The insurance policy was $290, remember? Now here's the thing. A bear call spread normally comes with risk. It normally does. You see, the risk is that the stock will go up. If the stock goes up, then we have an obligation to deliver shares at 35, and we've got the privilege to buy at 40. So we're going to be able to spend $5 to offset this obligation, and the $3.30 we get to keep, but the $5 we got to spend. Okay, if the stock goes up. Not cool, right? You might be thinking, hey, that's a $1.70 risk that you just added. Doesn't that even put more at risk? And the answer is no. No, it doesn't, because of the context. Here's Ravi's play. Okay, this is Ravi's play. Ravi, if you recall, has got shares at a cost basis of $27.50. Okay, so we plug that into the Power Options platform, $27.50. And then he also buys, while the stock is trading at $38.95, right? This is his cost basis, but while the stock is trading at $38.95, that's when he says, I want to protect my gains. And so he buys a $40 put for $2.90. Okay. Now the $2.90 is offset by this bear call spread, which brings in $3.30. Well, what happens if the stock goes up? You see, this green line shows what the present price of the stock was. Okay, and so he did this little play here, and if the stock price goes down, believe it or not, his profits rise. His profits rise because he's going to have a put option that's paid for, and he's going to have the proceeds of the bear call spread that he never has to pay back. And so even if the stock turns around, here's his locked-in gain. On the other hand, if the stock goes up, look at what happens. He gets to participate. He gets to keep going up. Why? Well, if the stock goes up a little, then the very worst thing that could happen here is that our 35 by 40 bear call spread closes against us. But after all, we're being obligated to deliver shares at 35, and he's out of them, right? But then he's been paid to own this call. And if the stock goes higher, why then we're sitting on a call that we've been paid to own. Okay, so this is his net position. Isn't that great? You're able to take a credit, which is much better than doing a cover call play. You're able to take a credit but not cap your upside. Now that's Ravi's play. What about for you and me? Okay, you and me, we would have a little bit of a different setup. Here's how it would look for you and me. We'd have this same kind of a deal. Ignore the numbers up here because the numbers will change, okay? But as far as winning, if the stock goes down, we're going to win. And if the stock goes up, we're going to win. And if the stock travels along sideways, well, the most that we could possibly lose is a single-digit percent. It's no longer 4.4. Down here, it's more like around 2.2 or something like that. So if the stock goes up, we win. I'm sorry, if the stock goes down, we win. If the stock goes up, we win, all right? And if the stock travels along sideways, we could lose, but there are some management techniques. Would you like to see them? I think so. Real quick, I'm going to check in and see what kind of questions we've got coming, okay? All right, no questions. That's great. We got 22 of you in the room. A couple of folks joined us. That's great. I'm going to, okay, it was 20 that voted in the last poll, 22 in the room. Got it. Okay. So, folks, go ahead and pose your questions by way of that question box whenever they occur to you, and I will get to them, okay? All right, cool. So, what do you think? Would you like to see how this works, okay? The reason that bear call spread cannot hurt us is that if we're called on to deliver the stock, all right, we already own the stock. Duh. You know, the thing that makes a bear call spread risky is the fact that you are selling calls at a low strike and buying calls at a high strike, but you don't own the stock. Well, if you own the stock, if you have it in your account, all the risk goes away. All the capital risk that's imposed by your bear call spread goes away, okay? And because we already own the stock, we can't get hurt. Rather than having to buy it on the open market, it's already in the account, okay? All right, so that's kind of cool. So here's the deal. The $2.90 for the put option is financed by the $3.30 credit taken from selling the bear call spread. If the stock goes down, we'll actually be able to keep this $3.30 credit, and this put option will rise in value. So we actually, if the stock goes down, we'll actually get out at a profit. On the other hand, if the stock goes up, we're going to be able to get a profit. And if the stock travels sideways, we may be able to manage it, okay? So it's like we've been paid 40 cents to insure our stock against loss. And guys, some of you may be in this position. You may have a stock that is up from where you bought in. And if that's the case, I highly encourage you to text in your stock symbol and your cost basis for that stock symbol, and I'll show you a live demonstration. We're not gonna buy or sell your stock or anything. And in fact, I've got to make the disclaimer: I'm not telling you what to do. Okay, but what I will do is show you something that you could do if you knew the technique. Okay. All right. So here's the deal. The worst possible thing that could happen did happen. Do you remember the bottom of that trough? Do you remember the check mark looking graph that we had in the bottom of the trough? The bottom of the trough was if the stock goes to 40. Well, the stock went to just about 40. Okay, so on expiration Friday, we've got a problem. Okay, the problem is we've got to buy to close that short call if we want to keep our stock. And it's going to cost $4.66 to do it. But I want to show you, we got a better price in this, but I want to show you even the worst possible fill of a bear call spread another month away would go like this. You would sell at $4.40 and you would buy at $90, and so you'd generate another $3.50 credit. Okay, now that's the worst possible scenario. Okay, but the point is this. We're going to roll the bear call spread out another month. Okay, and it'll become apparent why we're doing this in just a moment. Now, one thing a lot of folks don't get is that you can often roll a bear call spread at a credit. What that means is close the near bear call spread and open one another month or another 2 months away. But even if you can't do it at a credit, sometimes it has to be a debit like this one. Okay, we're spending $466 and taking in $350. Okay, even so, it can be advantageous to close and reopen it because you're delaying your delivery of your stock. Okay, rolling the spread delays your delivery, and the stock may go down or it may go up. If it goes up, 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 I mean like way up, you're going to make a lot of money. If it goes down, you're going to recover what you lost on the first bear call spread. Okay. Meanwhile, in this context, the stock going up or down guarantees a gain. Okay, and so this is what happened. Okay, on expiration Friday, the May $35 call was still in the money. Okay, but the stock had gone down. It was still in the money, but the stock had gone down. Okay, well, what if we allow it to be assigned? We don't have to. Okay, we can go ahead and buy back that call for 21 cents. All right, but what if we just allow it to be assigned? Okay, well then our stock goes away, and we also get to keep our most of our proceeds from that bear call spread. Okay, and the put option has also gone up, and we can close that separately. Okay, the put option has gone up, and we can close it separately. So that's kind of cool. Or you could keep it if you want to. If you want to spend the 21 to 25 cents to keep, to close the short $35 call, you could also keep it, all right, and continue doing this kind of a strategy, okay? But what I want to do is I want to go ahead and show if we just went ahead and let it go then, because what's happening is the stock is crumbling, okay? And if we decide, you know what, I'm out. That was a nice run, and I'm out. Well, here's the deal. I want to treat this just like a business. A lot of companies that talk about trading the stock market say treat it like a business. Well, a business has got it's got a profit and loss sheet, doesn't it? So here are the income statements. Here are the expenses. We've taken in $330 for the April call spread, and we took in $350 for the May call spread. So that's a total income of $680. Now, here are our expenses. We paid $2.90 for our insurance policy. Okay. And to manage our April bear call spread, remember the stock did exactly what we didn't want it to do. We didn't want it to kind of linger around 40 or approach 40 and kind of stay there. We did not want that to happen, but it did. That's what happened. And so we had to roll the bear call spread. Okay, so that is an expense also. So we have taken in $680 and we've spent $756. All right, now that's a net expenditure of 76 cents. And that net expenditure of 76 cents goes to owning both the stock and the put. Okay, now this is why this is significant. Okay, because $38.95 is what we spent on the stock. 76 cents is what we've paid for our put option when all the dust has cleared, right? And so our total invested is $39.71. But look, we've got stock plus a put option, and the put option happens to be a $40 put. And so that $40 put guarantees us we can get out and get out with a small profit. Okay, now so far this isn't super exciting, but I think you're going to really see the wisdom of it in just a moment, okay? 29 cents is not something to write home about, but it's also not shabby when you consider that we started with the stock at $38.95 and now it's down almost 10%, down to $35.21, and we've made a profit instead of taking a 10% loss. Okay, so that's kind of cool. So this was our original setup. Okay, the stock is at $38.95. It goes to $35.21. That normally would be a big loss, but instead we make a profit, okay, of 29 cents. So, if it were between you and me, I think I'd take door number 2. So let me ask you guys. I haven't shown the really exciting part yet, but I want you to think about what I just showed you. We began this play with a risk of 4.4%. Ravi began this play with a negative risk, okay, because of the cost basis of his stock. He couldn't ever get hurt, ever, okay? But you and me, we started this out with the possibility of losing 4.4%, and the stock went down, and we ended up winning, okay? Would that have been a better situation for you? I mean, if all of your plays last year you had set up in such a way that you couldn't lose more than 5%, if you were wrong about it, but you would make a small profit if it went a certain direction, and you make an unlimited profit and went another direction. Would it have been a better year? Let's think about this, okay? Let's think about this. I'm going to leave that poll up. It's been up for 50 seconds. I'm going to leave it up for another 10 seconds. I'd like to encourage 100% participation. Let's see if we can hear from as many of you guys as possible. Okay? I want you to consider your trading last year. Would limiting your risk to 5% or less have made a difference? All right, super. So, wow. So we just had some more folks jump in there. It fluctuated all over the place. All right, I'm holding out for 100% votes. Okay, I know that at least one fella is not voting, and I think it may be because he's calling in. Okay, so let me go ahead and close that poll, and I'll share the results. Okay, now some folks honestly said, and that's cool, honestly said, you know what, limiting my risk to 5% wouldn't have helped. Okay, I think the next thing I show you will help. But for those of you that said that, that's fine. I want you to realize that probably whatever loss mitigation thing that you're using, as far as, you know, maybe you're day trading, maybe just stay on top of it all day long and make sure that you don't take a loss of greater than 5%. Whatever you're using now, I'm going to show you something that I think is better. Okay, but let's address the other 75% of the room. Okay, so 25% said, yes, I might have still lost last year, but I would not have lost as much. Okay, well, that's honest. 13% said, wait a minute, this would be a game changer. I lost last year, but I would have won if I'd have done this. I lost last year, but I would have won if I'd have done this. That's a real game changer. And then 38% said, I did well last year, but I would have done even better. And that's the largest percent answer that we got. I did well last year, but I would have done even better. Okay, awesome. Well, thanks, guys. Thanks for your participation. Okay, now I haven't shown you the best part. Okay, let's make sure. I'm going to ask you guys. Okay, please let me know. Can you see my screen right now? Can you see where it says before stock at 38.95? Oh, I'm checking in, and we've got some questions going on here. Oh, good. Bill says, I've got shares, 300 shares of Skyworks. You've got SWKS. Bill, we're going to take a look at what you got. Okay, we got Dr. Nancy. Hey, I recognize you. Nancy was at one of my live seminars, live sit-down seminars, one of the first ones I did back in Delaware. Nancy says, plus all those commissions. Yeah, there are commissions. We do have to mention that. But you know what? There'd be commissions if you buy and sell at a loss. Why not, you know, pay some commissions when you buy and sell and have a small win? Okay? All right, so now what I'm going to show is the secret sauce. Okay? This is something else. Because for folks that own the blueprint, you have 12 different ways to get into to take money out of one of these positions where you have stock and a put option. You have 12 different ways, and some of those ways can be combined. Okay, what I'm going to do is show you something that, Nancy, you didn't pick up at that seminar because we hadn't done this yet. Okay, we hadn't figured out how to combine these particular income methods. So I think you're going to really dig this. Okay, we've only shown income method number 6, but during this time, we might also do another because income method number 4 signals were flashed. Okay, income method number 4. Now, here's the deal. On April 2nd, the RCI shares broke above $40. And that's significant because income method number 4 depends on whenever your stock is above the strike price of the put that you have protecting it. This is the indication to do income method number 4. Now, you wouldn't do income method number 4 if you had a short, just a plain vanilla covered call in place. But you can if you've got an income method number 6 in place. It leaves your upside completely open, and it also protects your downside better. And this is promise number 3. I gave you 3 promises, remember? The third promise was ratcheting up your exit point with something real rather than a trailing stop loss order. Okay, so here's what we're doing. We're going to take our July $40 put, which we had purchased for $290. But if you'll recall, that purchase was financed, right? So yeah, it cost $290, but then again, it didn't because we took some income with income method number 6. So we're selling it for $1.70, and that looks like a loss. But what it really is it's a transference. We're transferring from time value to intrinsic value. And here's the deal. We're taking time value, which will absolutely go to zero. This $1.70 will absolutely go to zero. And we're using it to pay for a whole lot of intrinsic value. You see, that July $45 put is still way above the stock's current price. The stock's current price is $40 and change. And we're able to pay for that intrinsic value with the time value of the first put. Here's the point. I am paying $3.70 in what we call the ATM machine. The nickname is the ATM machine, or income method number 4. Okay? Now, you might be thinking, okay, Frankenberg, you're spending $3.70 more. How's that a benefit? Okay? Well, let's think about it for a minute. Okay? Here was the situation before we did income method number 4. We've got our RCI at $38.95, right? We've got our, there we go. We've got our put and our income method number 6 permutations that we did to pay for that put. So now we're holding an instrument, all right, that the cost basis is $39.71, but we are guaranteed $40 back, right? So we're bulletproof to the tune of 29 cents. What that means is we have negative risk. It says amount at risk, but it's negative risk. We've spent $39.71 total, and our guaranteed return is 40. Okay, this is the situation before income method number 4. Okay, but during this time where the stock broke above $40, we were able to do income method number 4, and it adds $3.70 to the cost basis, yes, but it also raises the guaranteed return. So we're ratcheting up our exit point, just like I said in promise number 3. I said promise number 1, I'm going to show you how to bulletproof a stock. Promise number 2 was I was going to show you how to do a riskless spread trade. Promise number 3, ratchet up the exit point risklessly. Okay, so here's the deal. Now instead of an at-risk amount of negative 29 cents, we have an at-risk amount of negative $1.58. Kind of cool, right? Okay. And there's still some time left to expiration, so there's a little bit of time value in this. Okay. Now, again, on March 26, 2012, we had no idea if the stock would just break down from there, or if it would go up from there, or if it would go up and then down. And that is, in fact, what happened. It went up and then down. But Ravi wanted to be able to ride that stock up if it went up, but he didn't want to participate if it went down. Well, here's the really interesting thing. Okay. If we had a crystal ball, we don't. But if we had a crystal ball and we were just relying on ownership of stock, we'd be selling at the very peak at 40.68, making that decision, on the 26th. If we had our crystal ball on the 26th, we'd be saying, okay, from here, from $38.95, it's going to go up a little bit more. It's going to go up $1.63 more cents, and I want to capture every penny of it. That's what we would do if we had a crystal ball, right? We'd sell at the peak. Okay? Well, here's what actually happened. What actually happened is on May 18th, we're able to close the stock and the put separately. We could get out for $40 by exercising the put, okay? But instead, what we're doing is closing the stock and the put separately, okay? I'm sorry, we could get 40, yeah. And so here's what happened. The cost basis was $38.55, right? Because it was $38.95 for the stock, but then we also did our spread trades and we did our purchase of our put. And so we took, $3.30 in for the spread trade and $2.90 out for the put. So a net 40-cent credit. Okay. So anyway, bottom line is we've made a $1.59 credit. And when you divide that by the $38.55 invested, it's the same 4.2%. See, let's go back. I'll go back one slide. Okay, this is the slide that we would do if we had precognition. Okay, if we had a reliable way to predict the future, we'd hold on from our decision point on March 26th. We'd hold on for an extra 4.2%. 163 divided by 38.95. Okay? But instead, we're holding on and getting $1.59 divided by 38.55, same percent. We're holding on and getting that 4.2% bump. Kind of cool. Now, guys, when I talk about income methods, most folks' thoughts go to the obvious, which is covered calls. But selling covered calls limits your upside. You would not have been able to do this. Thankfully, I discovered a slew of ways to take income without selling covered calls. And, limiting your gains while leaving yourself open to losses seems kind of backwards. And this whole thing is spread trades. Spread trades are nice, but when you do spread trades, you take in your income with the caveat of, hey, you might lose 10 times as much as what you gained. Okay? Well, by combining the spread trade with this weird idea, I came up with that check mark looking graph. Okay? The weird idea is, hey, maybe we should try limiting our downside instead of limiting our upside, and employ income methods that leave this kind of a structure in place where we continue to ratchet up, but we don't leave ourselves open to losses. Kind of cool. Okay? All right. So, folks, that's the idea of radioactive trading. And what I'm going to do is I'm going to go to the polls again. I'd like to ask a question. Okay. I asked this question already. Think about what I just showed you. If you kept your losses down to 5% but left your upside open, would it have been a better year? And most folks said yes. 75% of the room said yes. Okay? I'm going to ask, how much better off do you think you would be? How much better off do you think you would be? And if some of you say, I wouldn't be better off, then go ahead, let me know. Now, stick around because we're going to also do that live demonstration with, I think it's Bill, with Bill's stock. Bill with Skyworks. Wow. Guys, I know that not everybody has voted yet, but many of you have, and this is almost overwhelming. This is almost overwhelming. Let me invite everybody to vote so we get a less one-sided answer here, but the answer is pretty much, yeah. I should have done this last year. Okay, I'm holding out for naysayers, but I haven't had any. So let me go ahead and close that poll and share the results. Okay, so 71% say I would be ahead by $1,000 or more, and 29% say this would have made at least a $5,000 difference in my trading last year alone. All right, so folks, I want you to consider that when you think about the cost of the home study kit. The home study kit is $600, and it has a satisfaction guarantee. The blueprints, which is part of the home study kit, if you really just want the bare bones only, you don't want the audio visual CD and everything, but you just want the book, that's $339. Okay, so $339 is what you could invest, and 71% of you say I'd be ahead by $1,000 if I'd have done that last year. Well, you could buy the blueprint for yourself and two of your closest friends, and then 29% said this would have made at least a $5,000 difference. Well, let me ask you something. Are you intending to trade for more than one more year? Do you think you might trade for another 5, maybe 10 years, maybe 20 years? How much will that make a difference in your account if you have this knowledge? Okay, kind of a good thing to consider. The income methods are used whenever we start a position. Normally, when we start the position, we're starting at a place where we hope it goes up, but we don't know. Okay, so when you buy your put insurance, that put insurance here is your bottom line, and the dotted line is your cost basis for the put and the stock. All right, so how much could you lose? Well, if you can follow directions, you can keep this at between 4 and 6%. Okay, but then the income methods can reduce that, and in fact, your income methods can reduce that gap until continually, again and again, until finally you reduce that gap to less than 0. And once that happens, we're what we call bulletproof. You can't lose any longer. And that's a very exceedingly happy place to be when an earnings announcement is coming up, or when some kind of black swan event happens, reducing that gap to less than 0. Remember my phone call. My mother called on what was it? May 6, 2010. She said, "Oh, honey, I know you're in the stock market. Are you okay? The Dow tumbled 1,000 points in 15 minutes. Mom, I was taking a nap. Love you. I'll call you back." You know, how'd you like to be that confident with your positions? So anyway, okay, folks. Gosh, I've got another poll, and then while I'm doing that poll, I'll be setting up Bill's trade. Okay. All right. So what do you think of the income method that I shared with you? And while that's happening, I'm going to pull up power options here. My wonderful power option platform. It's not my platform. It's I started out as a customer, just like many of you, and now, of course, I partner with these guys. And here's a nice side note: everybody in the office trades radioactively, even though they can do iron condors and butterflies and double diagonals and all kinds of bulletproof spreads and so forth. They have all kinds of different options available to them. Pardon the pun. What the guys in the office use with their own money is they use my method. Let's pull up, custom. Sorry, guys, this little pod's in my way here. I got to move things around on my screen. Okay, custom trades. There it is. Okay, we're gonna put up Mr. Good Looking. We're gonna put up Bill's trade here. Okay, first let me answer the poll here. The poll says 13%. That was wild. I didn't know you could do a riskless spread trade. Okay, 63%. This one trade made it worth all the time that I spent here today. 38%. I want to know more about riskless spreads like this. Good, because we got 12 of them, and I've shared 2. All right. 25%. Can I do what you just showed in an IRA or similar account? Yes, you can do this in the American IRA. You can do this in the Canadian. Oh gosh, I forget the acronym that they have for their account, but you can do it in the Canadian account. Everything that I showed today can be done in an IRA. I like that it reduces risk. Can it actually bulletproof? Actually, bulletproofing is sort of commonplace. It's not like a blue moon occurrence. It's not like a unicorn. Hey, I've heard of them, but I've never really seen one. It's actually something that we do around here all the time. Okay, so that's a good question. But yeah, it is possible to bulletproof your stock. And what we're going to do right now, I'm going to take a look here at the Skyworks position that Bill is in. Okay, Bill has got cost basis of SWKS of 59.10. Okay, so I don't know what SWKS. I don't know where it's trading at now. So it may be possible, may not be possible. I don't know. I'm doing this live. This is what is this today? It's June 4th, getting close to 1 p.m. on the East Coast. 59.10 we said. 59.10 is Bill's cost basis. Let's take a look. Okay, it looks like she's trading right now at 100. Oh goodness, yeah, you're able to bulletproof right now, there, buddy. You can absolutely do this. What is today? It's June. Okay, so July, August, September, October, November. November would be a good month to look at a put option. So let me go ahead and open that. And we might even go sooner than that, just because June, July, August. We'll see. Okay. Now I'm doing this on the fly. Okay, I'm doing this without a whole lot of preparation. I just wanted y'all to see this. Okay, so let's plug this in, and when I do that, it's going to grab the natural ask price. It's going to grab the 1330. Okay, but I think some of you could agree with me. We could get a better price than 1330. Maybe we could get 1310 or whatever. But what I'm going to do is just submit it the way it is. Okay. Now that seems like an awful lot to spend on insurance, doesn't it? Da-da-da, here we go. Okay, so it's possible right now for Bill to get into this place and pick up shares, not shares, he's already got the shares, pick up an insurance policy. But boy, does that insurance policy look expensive, huh? Okay, now what I'm going to do is I'm going to also insert something else. Oh, by the way, let's look at this number. The maximum risk is negative. It's a negative risk of 3760. And you're thinking, but I'm paying for that insurance. That's going to add to my cost basis. Well, yes and no. Okay, it's going to add to your cost basis. If the stock goes down, you're going to be glad you did this. Okay, I promise. If the stock goes up, there's ways for us to manipulate that time value in the put and guarantee an even higher return. Okay, I've already shown one of those ways, but there's more than one. All right, now what I'm going to do here is 37.60 is what you're guaranteed back. What I'm going to do is I'm going to insert, let's go with July. I'm going to insert a bear call spread. What we'll do with this bear call spread is we'll buy here and sell here. And instead of 37.60, I haven't pressed enter yet. Instead of 37.60 guaranteed back, we'll see if we just did a riskless spread trade. Instead of 37.60 guaranteed back, now we have 38.82 guaranteed back. Isn't that something? See, what we will have here is like a little bit of a check mark in the middle of our play. And by the way, this red here shows us that if we manage the play before expiration, we'll do even better. By managing this play, if the stock continues up, by managing this play, we can do even better. The red is halfway to expiration. The blue is at expiration. So this is one of those things where foresight is given. If your stock starts going down, you're glad that you paid for your put option with your bear call spread, right? Okay. Let's see here. That's one way of playing this. I have another way of playing this that I'm not going to show to everybody, okay? There's another way of playing this that, look, Bill, do you own the blueprint? I'm asking Bill that shared the Skyworks with me. Do you own the blueprint there, sir? I'm going to wait for an answer. No. Okay. All right, Bill, I'd be very pleased to share something with you that whether Skyworks continues up or whether it takes a turn to the downside, either way, you will profit greater than if you sold today. Let me say that again. There's a way for you to profit even greater than if you sold today, whether the stock goes up or down. And we call it Income Method 12. But I can't show it to the general public, but I'd be very happy to share that with you if you pick up the blueprint. Okay, so write me when you do. All right, folks, I'm going to ask if there's any other questions, and let's see. I'm going to ask this. What do you think? What is the single biggest objection that you have against getting the home study kit today? The home study kit will show you all 12 income methods and also the way to manage them. Okay? I know that there's objections, and it's okay. It's a happy thing. It shows that you're thinking. Okay. Interesting. Nobody's picking that middle one. I'm going to leave the poll up for only about another 5 seconds, okay? This is our last poll. This is it. Okay, 3, 2, 1. Okay, still nobody picked that middle, okay? So essentially, some folks have the price objection. Now, the price objection I'll handle really simply for you. It's guaranteed. With a money-back guarantee. You know, I've been doing this for a number of years. Dr. Nancy picked up the blueprint, I think, was it 6 years ago, Nancy? I think she picked it up 6 years ago, and, it's still coming around to these webinars and so forth. We've been in business for quite some time, and we wouldn't be in business if we offered a product that was crappy and we also offered it with a 100% money back guarantee. So that should handle that objection. The other objection is I've been waiting for a sale or a special. Never going to happen. Sorry about that. Never going to happen. I did that one time in 2007. And it was for my birthday. I said, today's my birthday, so I'm giving away a gift. If you've been on the fence about getting the blueprint today, it's half price. And we had a slew of orders. I had no idea that there's so many people that were waiting for a sale. I didn't realize that. And we had a slew of orders. And what happened was we had some angry people that had spent money, full price the day before. So I had to do a lot of refunds, because refund half of the price anyway. And we also had such an influx of new customers that the questions that we were supporting, support at radioactivetrade.com, we support the materials, right? And so, we were scrambling to have qualified people be able to answer those questions and answer them, correctly, and not get people into trouble. So it was a real nightmare for us to offer a sale the one time we did it, and we've determined that we're never going to do that again. It's just not, it's not worth it. We charge what the material is worth, actually quite a bit less than what I think it's worth, and then we support it 100%. We support it with your questions, and we support it with 100% money back guarantee. Okay, so let me go ahead and hide that. So objections have been handled. Folks, if you haven't picked up the blueprint, make it a resolution to do so. I think you're going to be really pleased and impressed. And there's really easy explanations inside the blueprint. Talk about the phenomenon of how time value swells at the money, and how we're able to, with our income methods, buy out of the money and buy in the money and stay away from at the money. And on the other hand, when we are generating income, we flip that. Okay, we sell calls or sell puts that are in the ATM zone. You saw that with income method number 4 today, right? We took a put that was essentially at the money and swapped it for a put that was in the money, and it made $1.30 difference in the exit price. Kind of cool. Okay, so what had been the problem? Today, what was the problem? The problem was, we could purchase RCI at $38.95 and have no guarantees of where it was going, up or down. Okay, and as you saw, it tumbled. Okay, it tumbled. After a short rise, it tumbled. But what's possible? What's possible is that you can build a fence around the stock with options. Okay, you can get paid to have an insurance policy on your stock. That's possible. Okay, and what's different now? Well, on the way up, income method number 4 locked in a better exit price, while income method number 6 was paying for insurance. So that's kind of an exciting proposition. We were able to roll the stock up as high as it was going to go, and then get out. Okay, get out with and actually get out after the fact. After it had peaked, we're able to get out and look back and say, hey, we could not have done any better if we had a crystal ball. We couldn't have possibly, we held on for a 4.2% extra gain. And if we had a crystal ball, we would have been able to hold on for a 4.2 extra gain. How about that? Okay, so anyway, here's how all the, all the numbers worked out. Okay. And so what? I know what you're saying, so what? 4.2% is really not something to write home about. So what if you can lock in a price? So what if you can bulletproof your stock? What's the big deal? Well, the big deal is I haven't shown you some of my plays that I've done with this. I haven't shown you Mike's play. Mike even doubled this. Marvel, when I was sitting on Marvel, I had used income method number 6 and put options to lock in and bulletproof my Marvel stock. And then along came Disney and said, I'm going to buy you for $4.4 billion. What do you think of that? And so my Marvel stock goes to a 30.2% gain on the invested dollar in 2 months. And during this 2-month period, I'm bulletproof. What can you say to that? It's kind of cool. Mike was able to buy into Silver Wheaton. Mike Chupka in the Power Options office bought into Silver Wheaton, and he ended up making a 58.9% gain on a bulletproof stock. He's bulletproof, cannot lose. I mean, he started out with what? With 7% at risk, and within the first month did income methods and bulletproofed himself. Then he sat on it for another 4 months after that. Ended up taking 58.9% on his money. Okay, so the point is, I don't like to make claims that, hey, you're going to make a 30% gain. But what I can make as a claim is, hey, you can put yourself in position to make a 30% gain, a 60% gain, but at the same time, make it heads you win, tails you can't lose. It's possible to bulletproof yourself, or at the very least, start out with just single-digit risk. And if everything goes wrong, if the you-know-what hits the fan, the most that you could lose is 5%. We asked this question. Think about what I just showed you. If we kept your losses down to 5% or less for all of your losing plays last year, would it have been a better year? And most of you said yes. So, folks, that is the show today. I'm about 10 minutes past the hour. I'm going to go ahead and check in and see what questions we've got. And I'm going to encourage you, if you haven't picked up the blueprint or the home study kit, that you do so today. We do have some special offerings that you'll find when you check into the buyers section there. It's at radioactivetrading.com/products.asp, or just go to radioactivetrading.com and find the products tab. Okay, questions? Kabam. Well worth the $600. It's possible to make it back in one trade, says Jill. Thank you, Jill. Appreciate that feedback. Very cool. I happen to know that Jill has recently picked up the blueprint or the home study kit. You're welcome. And Jill, when you're ready, before you get into your first radioactive trade, please use your support. Write to me at support@radioactivetrading.com before you pull the trigger. It's not like I'm your broker, but I can give you a second set of eyes, and that's what the support is all about. Okay. All right, folks, we're going to go ahead and close it up. This is Kurt Frankenberg signing out, and the recording will be up for another 4 days or so after it gets up, which should be tonight or tomorrow morning at the latest. Okay, we'll see you out there, and you're welcome. A couple of thank yous. Thank you from Jill, too. Appreciate you guys. We'll see you out there. Happy trading. Oh, you know what? A question came in, and I better answer it. Okay, Marv says, great book. I own it. When will you write up Income Method 12? Marv, Income Method number 12 is available as a PDF. It's not available because of the printing. We did we printed a whole lot of books. And so it's available as a PDF. And in the next go-round, in the next printing, there will be Income Method number 12 in that. But the information is available. So, okay. All right, folks, we'll see you out there. Happy trading, and bye for now.